Hi, I'm Angie and this is UK Money Wisdom with another up-to-date video on your state pension. Your many comments are revealing that millions of pensioners are discovering missing money, lower weekly payments or unexplained deductions on their state pension forecasts. Today in this video, I want to answer all of your questions and comments and expose the hidden, complicated and changing rules inside the UK state pension system that almost nobody will explain properly when you ring up. Now, your questions mostly cover people with 35 years of national insurance still falling short, pension increases frozen for 500,000 pensioners living abroad, confusing deductions like COPE suddenly appearing, or steep drops in pension transfer values, or a government bill giving new powers over pensioners' bank accounts. I have made a detailed video on the WASPI women and will make one for each pension topic also, so do leave your comments below if you'd like me to. But for today, by the end of this video, you will understand exactly what each of these means in helpful, simple language. Besides the confusing terminology, your pension forecast contains rules built up over 40 plus years. Here they are, and today I will explain each of them in detail. You have SERPs, State Earnings Related Pension Schemes, S2P, which are second state pension, contracting out, GMP, which is guaranteed minimum pension, COPE, contracted out pension equivalent, DB, defined benefit pensions, and CETV, cash equivalent transfer value. For people, these may be just letters. Today they become crystal clear. Let's begin with Section 1, Contracting Out, GMP and COPE. So, what was contracting out? For many years, millions of workers were contracted out of the extra part of the state pension. Originally, this extra part was called SERPS, the State Earnings Related Pension Scheme, then renamed S2P, the State Second Pension. If you were contracted out, you paid lower national insurance. The government reduced your extra state pension, and instead your workplace pension promised to replace that lost slice. To guarantee this, workplace schemes had to provide a minimum amount called GMP, Guaranteed Minimum Pension. This is the minimum pension your employer's scheme must pay because you were contracted out. So, if you see a GMP in your workplace pension paperwork, that is why it exists. What does COPE mean? On your state pension forecast, you might see COPE, which stands for Contracted Out Pension Equivalent. This is simply the government's estimate of how much pension your workplace scheme should pay you because you were contracted out. Important points to note are COPE does not reduce your state pension at state pension age. It is not a tax. It is not a bill. It does not mean you owe money. It's just a reminder that part of your pension sits with your workplace pension instead of the government. Let's look at why 35 years of NI isn't always enough. We were told 35 years of NI gives you the full pension. But for people who were contracted out, this isn't always true. If you take NI, National Insurance Contributions, you may find if some of your 35 years were contracted out years, your starting amount in April 2016 could be lower. Here's a typical example. 38 years of NI, National Insurance, 15 years contracted out. Result, pension forecast still falls short of the full amount. And why is this? Well, this is because the government assumes your workplace pension is covering part of what the state no longer provides. In section 2, we look at GMP, Guaranteed Minimum Pension increases and step-ups. Why do pensions jump at certain ages? So some people see their workplace pensions suddenly go up when they reach state pension age or at age 65. This is due to the scheme paying increases on the GMP, the Guaranteed Minimum Pension, because before 2016, the government used to pay these increases. Now, the workplace scheme does, so your state pension may look lower, but your workplace pension may increase later. Over time, the income balances out. In section 3, we look at frozen pensions overseas. What does a frozen pension mean right now? Around 500,000 or more UK pensioners abroad have frozen pensions. Well, a frozen pension means you still get your state pension, but it never rises with inflation. No triple lock increases, I'm afraid, and it stays forever at the rate you first received it. Now, this affects pensioners in Canada, Australia, New Zealand, South Africa, and many Commonwealth countries. It does not affect pensioners in the USA, the EU, or the EEA, which is the European Economic Area. It is not based on how many years you worked or paid NI. It is based only on where you live, a policy widely seen as unfair. Let's move on to section 4, deferred defined benefit pensions and dropping CETVs or cash equivalent transfer value. Why transfer values fell? Many people are asking why the lump sum transfer value of their workplace pension has dropped so much. A workplace pension like this is usually a DB, a defined benefit pension. This guarantees a set income for life, usually linked to inflation or wage increases. If you ask for a transfer quote, you receive a CETV, cash equivalent transfer value. This is the lump sum you could take if you move that pension out of the DB scheme. So why are CETVs lower now? Because when interest rates rise, pension schemes can buy your future income more cheaply. So the cash lump sum they offer becomes lower. The pension income itself usually continues to grow. Only the transfer value changes. In section 5, I'm dealing with the error and fraud bill that came in at the beginning of 2025. Still a bill. And why it worries people. Well, the error and fraud bill 2025, as I said, is a proposed law, and it includes wider access for the government to view bank account data, automatic deductions from pensions or benefits if they believe there was an overpayment, even when the mistake was the government's, not the pensioners. Supporters say it targets organised criminals. Critics say it treats honest pensioners and disabled people like suspects. Many viewers have asked for a separate deep dive video on the fraud, error and recovery bill, which I'll be making very soon. Let's look at section 6 and NI top-ups to find out when paying extra NIs is worth it. If your state pension forecast shows missing years, you can voluntarily pay extra national insurance. One missing year currently costs around £923, 2025-26 rates. In many cases, that adds over £342 per year to your pension, every year for life. But never pay first. You must ask HMRC to check that the year is valid. Paying will increase your pension and you won't accidentally overpay. The Future Pension Centre can check this too for you. In section 7, I'll give you a brief recap on the WASPI compensation. WASPI stands for Women Against State Pension Inequality. This campaign is not about changing the pension age. It is about the government failing to give proper notice to millions of women born in the 1950s. Compensation should include lost income, stress and hardship, and serious financial consequences. You'll find this in a very recent video that I've made. So my final message for today is to check your own situation. 1. Look at your state pension forecast. Check if you were contracted out. Look for COPE. Check your NI years. Ask before paying voluntary NI. Don't panic about CETVs, those cash equivalent transfer values, without proper advice. If this video helped you understand these confusing terms, please like the video and subscribe to get more videos, which will be coming thick and fast in the near future. And do comment with your pension question below. I'm Angie, and this is UK Money Wisdom. I wish you all a very good remainder of the day, and I will see you again very soon.